And Nathaniel's right. People have to learn from mistakes, and that's not necessarily a bad thing to learn from mistakes. But I will say that I don't feel there's enough life to learn from all of your own mistakes. So pick and choose which mistakes you want to learn from others and which ones you want to experience yourself.
Welcome to Critical Thinking Required, hosted by LBW. This podcast is intended for free thinkers, entrepreneurs, and knowledge seekers. Join us as we discuss relevant financial topics, explore with guests their financial journeys, and engage with experts in industries such as space, media and entertainment, real estate, and many more. Buckle up and enjoy the ride. Welcome to Critical Thinking Required. You're with your hosts, myself, Tim Bickmore, and my two colleagues, Dan Weiss and Nathaniel Leach. And we have no guests today because we are doing our quarterly update. So it's just the three of us listeners. You get to hang out with us, talk about some of the things that happened in the past quarter. If you enjoy our episode, please like, share, and subscribe to our podcast channel. We are all over the place. We are on Spotify, Apple Podcasts, Buzzsprout, you name it, we're probably on there. If you could subscribe, like it, share it, maybe give us a comment, we'd really appreciate it. It will definitely help us continue to do the fun work that we're doing on this wonderful podcast. So please do that if you can. With that being said, Dan, take us away for a Q2 update.
So we're going to hit a big topic, and one that we expect that it's not the last time we talk about this in the near future. And that is inflation. Now, we spoke about inflation or fears of inflation, thoughts of behind inflation and rising rates last quarter, as Tim mentioned. There have been a few changes since then, and some things also remain the same. So I'm going to turn this right back over to Tim to share some of our thoughts and what we are seeing as it relates to the subject of inflation and the rising rate concerns. Tim?
Yes. Not a lot has changed since we talked last quarter. The Federal Reserve had its recent meeting in June, and they had come out and they had stated that they're based off the projections from the committee, they may start upping the federal funds rate sooner than expected. But if you read the actual statement, they say that this is in no way indicative of a plan or any stance on what's going to happen, because they said nobody on the committee knows what's going to happen to the economy over the next few years. So I think that's something that should be stated, that they actually state within their system. Now, where is inflation going to go? I think it, again, depends on just who you read, who you listen to from an economic standpoint. There is a lot of reasons for why inflation could continue to go up. We have seen inflation in a lot of different routes. Housing is one that we're going to probably talk about on this podcast. Construction goods, so lumber, cement, different materials and commodities have increased. Some of this is transitory inflation, is what some people may state. Others think that it may be here to stay. What will be interesting, which is some new news, is the infrastructure bill that has been proposed. So I believe it's roughly around $1 trillion. I'm not sure exactly what is included within that bill, but if we are going after some infrastructure, you could see potentially cost when it comes to building homes still be up there, because you're going to have a flood of cement and other materials where there's already a constraint just on the supply dynamics. So the supply chain and different things. So it's just, honestly, it's really tough to say one way or the other where things are going to go. All I can say is that if inflation goes up, interest rates will follow, and vice versa. So the biggest question is, do we see hyperinflation like we saw back in the 80s? That's what people are potentially worried about. And what does that do? It's a tough one. It just have to kind of wait it out and see what happens. I mean, as Dan talked about the other day, we have somebody who's over in Singapore, and Singapore is in a full shutdown currently, or was as of, I think, last week. And so, COVID hasn't gone away necessarily, but remember, we are a global economy, and those supply chains were extremely disrupted during this pandemic. So it's tough to say what is transitory and what is not. It's tough. It's kind of if I had that 8 ball, I would let you guys know.
The only thing I would add on is that nobody knows what's going to happen with inflation. Conversely to Tim's points about supply chains and such with inflationary forces, there are indications that prices of commodities are falling. For example, processed lumber has decreased approximately 19% or so from its most recently met high. So it's not just one big, everything moves in motion. There are waves that run counter to one another. There is no set direction that the US or necessarily the world is going. It's completely dependent upon millions, literally millions of, actually billions, technically, billions of variables. And the billions that I'm referencing just alone are the billions of people that are on this planet. Every single person makes choices every day that affects these kinds of forces, and they can gather together in big forces, and they can then shift in that fashion. And it could just be little pieces here and there that are just, and then you never know.
Fantastic, the two of you. Thank you very much. Moving on to our next subject, and I'll kick this one off a bit, and I'm sure that Tim's got some thoughts to share on this one specifically. We're going to talk about some waiving of contingencies as it relates to residential real estate. Tim foreshadowed that a little bit, specifically one in particular. So recently we did a podcast that has not been released yet. It will be coming out in the next couple of weeks, that really zeroes in on mortgages and some rising prices in real estate and those markets and so on. This is a glimpse on one of those pieces that we felt was such a just mind blower that we needed to mention it again on this quarterly update. So what I'm referring to among waiving financial contingencies have been around for a long time and is probably not going away in a lot of markets. But there's one in particular where we're just dumbfounded that this has come up as much as it has, because it really scares us. And yes, Nathaniel.
Sorry, just for our listeners, could you explain like how financial contingencies, what that means for houses and homes and stuff?
So briefly, when we talk about removing contingencies, when you go and you buy a property or you attempt to buy a property, you often have or can have contingencies in place to allow you to back out of that deal if something occurs. So the most common one is financing contingency, meaning that your loan falls through for some reason, so you can't get the house. That allows you to back out of the offer. You're not stuck holding the home. Like an appraisal contingency could come into play, right? Where if the value doesn't hold up according to the bank, you can get an out of this property, right? You waive that, and then the bank says whatever that difference is, you got to come up with. The one that we're talking about is waiving home inspections. There's just so much risk involved in doing that that can cost you so much money. But I've spoken enough. Tim has been deeper in this process recently. I'm going to yield to him on any thoughts he may have. And if he doesn't share some examples afterwards, I'm happy to.
Waiving of inspection is a risky play that I'm not willing to do. And I think that unfortunately within at least the Madison market, it is become the norm where if you're in a competitive bid, which most likely if a house goes up for sale, you're probably already in a competitive bid, that waiving those inspection fees is going to be something that the seller would like to see, because that's what they can get. And the reason why they would like to get it is they could say, hey, my house is worth, I don't know, $350,000. That's what they're going to list it for. Within our marketplace, you're probably looking at buying that house for anywhere from probably $360,000, $375,000. If it's really, really nice in that range, maybe all the way up to $400,000. So $50,000 over asking. If you go ahead and then waive your inspection fee, and let's say that, they didn't disclose, for example, that there was a water leak, that there was some damage, that maybe there was some mold, even though they may have got it remedied or fixed, maybe they didn't have to disclose that. You're not going to find that in the inspection until after you own the house. But maybe they didn't fix all of it, and it costs you another $10,000 to $20,000 to fix whatever is the issue with the home. Then all of a sudden you're stuck not just paying an extra $50,000, but maybe an extra $60, $70, $80,000 for a house that most likely is probably already overvalued. And so the inspection is very important, because you got to understand the condition of the home. Now, to be very upfront, the inspection isn't always going to catch everything. It's not going to show you every little detail if you've gone through it, but it will at least give you some idea of the condition. And then if you can back out and say, hey, whoa, I'm going to pay you an extra $50,000 on top, but you're telling me there's $10,000 to $20,000 of damage here that I don't want to cover. Now, it's even gone as far too, as where if you don't waive the inspection, but you can put in like a floor, and you can come in and say, well, I'm going to pay for anything up to $10,000. So if there's $10,000 worth of fixes, I will cover that. But if I find that there's $11,000, you have to cover the additional $1,000. That's still pretty nuts, but it's a way that you can kind of not necessarily give up the inspection, but give the overall seller a little bit of a good faith effort. But it's just pretty crazy. We've had some realtors tell us that clients have gone in and waived the inspection. They explained it to them. They said, hey, this is what you're getting yourself into. And then they go, oh, yep, we're good. Then all of a sudden they get the inspection. They're like, hey, whoa, wait a second. What did we just buy? And it's kind of like going in and buying a t-shirt without trying it on. And it's like, whoa, this is way too small. Like, I want to return it. Like, sorry, it's yours. And now it's kind of useless. It's a little bit, I guess, of an analogy there. So it's an interesting game. Nathaniel, you got something to add to that?
I just like to pound home the concept of, if you were to find something and it costs an extra $10,000 to $20,000, you not only, as an example, you not only paid at a higher price, as Tim said, but that's an additional $10,000 to $20,000 that's actually out of your pocket. It's not that something that you can roll into the loan, for example, if you wanted to, or it might be you would then have to get, for example, a HELOC, a home equity line of credit, if you wanted to more feasibly pay for such an improvement. So it's really scary. It's not only fascinating, but it's also very scary, because people who are buying these homes with some issues are opening up themselves to not only potentially huge cash expenses, but also in some cases, like with mold, as an example, health issues.
And it's a really good point, Nathaniel, that you bring up. And the thing is with the HELOC, that's if you even bring 20% down to the bring 20% to the table. So if you're going in at 3%, 5%, you're not getting a HELOC to be able to take that money or that cash. So it's also very dependent on your overall down payment to turn around and get that quote unquote second mortgage or a HELOC. Which is very, very important, because a lot of people aren't doing that either, bringing 20% down because they either just don't have the cash on hand, which gets them in a really tight cash crunch quick.
And these two concepts go hand in hand, right? So if you don't have enough cash to be competitive there, and you're trying to be more competitive by waiving a contingency like this, and then you find these issues, you don't have the cash to take care of it. And if those issues are really more than cosmetic issues, then potentially could remove you out of this house that you have, and leave you in a situation where facing a foreclosure is not out of reach. And I'm very interested to see if this actually becomes a greater fad as to what that does to the housing market. If people end up buying homes, not that they can't afford the actual cash flow of it, but can't afford the repairs. Will be very interesting to see how that plays out.
Well, and ask anybody how easy it is to get a contractor right now.
Yeah, it's not good, and the costs are extremely high. I mean, I wouldn't. If I were to buy a used car, I really want to know all of the history of that car before buying it. If I buy a house, I want to know that even more so, because I plan to be there longer, and I expect it to be more expensive, well, depending on the car, of repairs. And frankly, there's probably more things that can go wrong. So, just out there, we just wanted to beat that horse a little bit further from the podcast that's coming out. But wow, just incredible. And really, I mean, we haven't heard of this being a mainstream kind of thought. until really the last couple months, which is crazy in itself. Okay, next subject, I'm going to push off to Nathaniel to start with. We want to talk about this idea of fractional shares, fractional investing. It's something that got a little bit of attention last year, but I guess amongst other things, it didn't pick up perhaps as much attention as you may have thought. We expect to see more of this. We've had a few questions on it. So fractional share investing, Nathaniel, go.
Okay, so what is fractional share investing? So today, Berkshire Hathaway, the company stock, closed at $416,304 per share for every A share. There's also B shares at a much lower price, but we're going to use the A share as the example. So what fractional share investing allows for is for me to, since I don't have $416,000 just sitting waiting to buy one share. But if I could get a hold of fractional share investing, I could, let's say I had $4,000. I could then go buy 1/100th of an A share ish and purchase that Berkshire Class A share. Not the entire share, just 1/100th of a share. That's fractional share investing. So fractional share investing has been around for a little while now. It's been around in actually some forms. For example, before it was easy for investors to reinvest their dividends through custodians or brokers, the individual companies would establish programs called DRIPs, Dividend Reinvestment Program. And it would allow for investors in their individual companies to reinvest their dividends within the company at zero cost to the investor. And that concept has been around for decades. But the fractional share investing that we're referencing is now going mainstream on other brokers and custodians. So for example, if you were to invest with Charles Schwab as a retail investor. So remember, as some of you may know, we, LBW, are categorized as institutional investors because we invest other people's money. If you decide to do it yourself and invest your own money, you would be called a retail investor. So Charles Schwab allows for retail investors to do fractional share investing. So these are becoming a very mainstream type of thing. So there's differences in perspectives about whether this is good or bad. The good is that I can buy Berkshire Class A shares. I mean, that's very unattainable for many people. But to say that you own a piece of a Class A share, that can be a really nice feeling to have. And historically, it has been a fantastic investment. And so long as you hold on to, as with any investing, like we always say, investing is a long-term game. You hold on to something for the long term, stick through it, through highs and lows, you're bound to do well with time. Conversely, there are others who say, well, actually, I'm going to pass that on to Dan because he knows the bear case pretty well. Yes. I'm an optimist. Dan's a pessimist.
Yeah, that's true. And I think Nathaniel starting to invest at age 15 probably would have drooled over this concept because he had no money. And there would have been a lot of other things he could have taken advantage of. And before I bash the concept, just to show that there is some optimism that lives inside of me, another example of this is I was speaking to a woman who had some wonderful questions last week, and she said that she really is interested in this kind of concept because she wants to buy things for her kids. She's got a couple kids. She doesn't want to spend a whole ton of money, but she wants to instill this concept of owning entities as real entities. And I think that often does get forgotten about, that when you buy stock, you are buying a piece of a company. So, her point is, if she buys a share of the company, it's more, it's the word I'm looking for. It's more of a realization that you own an entity as opposed to buying a fund that owns a whole bunch of entities. I get that. And that she could do more by buying for these kids in an account to grow for 18 years for them. Excellent. Get it, appreciate it. Okay, here's some problems with it. So one issue that I have is that I think it encourages a more of a trading society, which I think we've seen a lot of in the last recent couple of years, especially this past year, in 2020 and into this year, where we have people that will just trade like it's a casino. And I worry that if you can do this, it's only going to encourage people to do less research, because it's only going to cost them a few dollars as opposed to perhaps a few $100 buying, depending on the stock. So that's a concern that I think it actually might create less research and more trading among people that detracts from the idea of buying an entity, a quality entity, and holding that entity until it provides you a value you're trying to obtain over a period of time. Worry that it's contrary to that. The other issue that I really have too is I don't know that it's in the company's best interests. I don't, just like I think it's maybe not in the market's best interest to have an increased amount of volatility due to trading. It also means that people are trading those companies' currencies in a sense like crazy too. And if I'm an entity, I don't know that I want to actually deal with that either. So I think there are some trading issues that come into play here that I wish I could say that I think most people will not treat it that way. But again, now there's the pessimistic viewpoint. I think they will. And that I think is a concern. But I imagine everybody will be doing it soon, because it is a selling topic. And at the end of the day, these custodians want to sell. And one more piece actually off of that in itself actually bothers me too, because even though I understand that it's not the responsibility for these entities to look out for the common good of the retail investor who doesn't know different, perhaps, that's not their responsibility, but to some extent I feel like it should be, because I don't see that education elsewhere. And I do feel that professionals that understand what these ramifications should be or can be, they have an unsaid duty to protect those who don't. And especially when we know that they're not going to look into it. We could say all day long they should look into it, okay? But to be real, most people aren't. And so I think there has to be some layers of protection in place because of that. Anyways, Daniel, any other thoughts on that?
Counters. I've got counters.
You just all day. Yeah.
So Dan is right. There's going to be people who take advantage of this and trade frequently. But as with any innovation within finance, there are both good and bad players. For example, leading up to the 08-09 crisis, we all know that a big piece of that led to that crash was a lot of these things called CDOs and CLOs, and these were built upon the financing of mortgages. So they were basically pieces of mortgages sliced and diced together and then sold to investors. That concept started much smaller and was based upon institutional investors wanting to have a safe return asset that was fairly liquid and was slightly more risky than sticking their money in treasury bonds, and therefore had a slightly higher return. But as more and more of these were financed, as more mortgages were financed because people were just naturally buying more homes, it began to accelerate, to snowball, because these fees that the banks were receiving to wrap up all these mortgages and sell them to investors were very appetizing. So it incentivizes them to create more and more and more, which therefore led them to lower their underwriting standards, to accept riskier mortgages, to then wrap up those riskier mortgages. And then they could say, hey, look, this other CDO that we created 3 months ago or 6 months ago has had great returns. Therefore, we're going to stick a stellar investment grade rating on this newly created one, when in fact, it had much shittier mortgages. So the original concept was a well-balanced approach. But as with all things, it can go good or bad, heavily so. People will be people. There's no changing that. Unfortunately, people have to get hurt. People have to make mistakes. People have to be ignorant, and people have to lose money in order to learn from their mistakes. Now, they could choose to live vicariously through others who have made mistakes, and then you can learn from them and then not make those same mistakes. But some people learn differently. People will choose to live their lives however they choose. Now, I'm not going to negate Dan's point, though, about these companies should be more keen to be aware of the bigger picture. So perhaps to place guardrails up such that investors can't make serious mistakes, or provide educational resources to them and encourage them to learn about these products, fractional shares as an example, and before they start trading them and buying and selling and such. I see nothing wrong with that. I think that in fact, that would over the long term benefit the companies, because so long as their customers remain solvent and continue to trade, then the companies are going to make more money. It's not rocket science. But unfortunately, companies are usually incentivized for the short term and choose to make more money as soon as they can, as fast as they can. And they either can't afford to, or they choose not to look to the long term. So I think that unfortunately, the frequent trading, I think that just has to happen, because people need to experience and then the downside, and then they'll just naturally filter out of fractional share trading, and then it'll eventually settle to such that retail investors who are investing for the long term, they use it correctly, and I think that those people will go on to do very well for themselves.
Well, then in close, I'll piggyback off that leading into our roundtable here. And Nathaniel's right. People have to learn from mistakes, and that's not necessarily a bad thing to learn from mistakes. But I will say that I don't feel there's enough life to learn from all of your own mistakes. So pick and choose which mistakes you want to learn from others and which ones you want to experience yourself. And I suggest you're very choosy about that, because some are way more catastrophic than others. But there should be a mix there, perhaps. And I still would prefer that mix to be learning from other people's mistakes. And the other piece I'll say too is that Daniel's also right about original intent. Original intent is interesting because, especially in the financial world, we just so often see things that just go awry, right? They're designed for one thing, and someone finds a way to make money off it, typically fill whatever incentive they have, and starts getting fitted to holes that it should not fit into. And eventually, that always comes with a mistake at the end of it. Maybe not for that person who originally did it, because perhaps they're long gone from that situation. But somebody, like Nathaniel's saying, will be holding that bag. It will be flaming. They will get hurt. And a lot of times we find that because It's not the original intent of whatever instrument, vehicle, methodology that they were planning to use. And finance is the king of doing just that. Tim, what you got for us?
Oh, listening to the fractional shares conversation, my final thought, and it even goes back off inflation and just thinking about it more. I don't know who said it or where I've heard it, but I've heard it multiple times. I feel like I heard it from Monish Pabrai at one point. I think I've heard it from just other philosophers or other great thinkers, but it's living above the clouds while living in the clouds, in a sense. And I think that's really what it comes down to. And what I mean by that is we live in an abundance of information. That we're in the information age. It's an abundance of information that you can gather yourself, and you can go and become an expert on a lot of things. But until you actually get involved and do it, you don't understand the nuances to that specific skill set. Be it a banker, be it a contractor, a financial advisor, an investment manager. And that's what really starts teaching you. Now, I think Dan's right. It takes a lot of time to learn from your own mistakes, and sometimes it's easier to learn from others. And I would just highly suggest that you find people that you trust that are doing certain things, that are really in knees deep in it, and they do it on a day-to-day basis consistently. And to start asking the opinions, start asking the pro opinion, start asking the con opinion, right? And understand that, as Nathaniel said, we live in a complex system, period. We are in a very complex system in a lot of different realms. And you really do have to, no matter what, you have to live in the clouds, right? Listen to the media, whatever it may be, but you also have to live above it, in the sense that you got to start coming up with your own opinions, your own objectives, your own thought process, and really start taking a dive into into understanding. I say that because inflation, you can read a million different things on where inflation is going to go or not go. Fractional shares, you can listen to Dan and hear the con side. You could listen to Nathaniel and hear the pro side. Both valid comments, both valid situations. But what you have to do is you have to understanding it for yourself and start positioning yourself to make those decisions, and then watching it from others. And it's just continuingly to compound your knowledge over time. But the best way to compound your knowledge is to start talking to people who are knees deep in whatever you're trying to figure out. Like, for example, for us, we love talking about this stuff. We nerd out about it. Ask Nathaniel about fractional shares. Ask him about long-term investing. Ask him how it is to run money. What is that like? Start taking from him. And how can you apply it to yourself, right? That's just because he does it on a day-to-day basis. So my last and final thought is just really taking, Dan says it very well, an instructive tongue. And what is it, Dan? An active, what's your quote that you've been saying lately that I like? Say it.
Have an instructive tongue and an attentive ear.
And that attentive ear is something that will pay dividends.
That's a great analogy, Tim. Really like that. I'll just hit on the main points that we touched on today. Real briefly, inflation, nobody knows what's going to happen. Could be transitory, or it could be here for a while. No one knows. With regards to waiving home inspections, I wouldn't do it. And you're literally putting your health at risk. Why screw around with that? And then with regards to fractional shares, I did some quick math. So if I had the ability when I was 15, this was about in the 2000 timeframe, if I had the ability to purchase a portion of a Berkshire Class A share, I believe that at that time, Class B shares didn't exist. So if I had been able to buy a Class A share then and still held it today, I would have a 9.7% return. Now, on the face of it, that doesn't seem like that much. If you compare it to the S&P 500, though, the S&P 500 with dividends invested had a 7.17% return. So let's do the math, shall we? If I had invested $1,000, okay, let's see what that dollar difference is, shall we? So over approximately, that's about 20 years, right? So 1.097, did I say 9.7%, right? Over 20 years times 1,000, I would have $6,369.90. Okay. One of you two remember that. All right.
Say it again, one
Now,
more time.
I just deleted it. I think it was like, let's say 6390. 6390. Okay. So then 7.17, right? Excuse me. You would have a total amount of $3,994.52. So that difference is $2,395 and change. Okay. That is nearly a 38% difference in total amounts. That's the power of long-term investing.
She's dropping the mic, it sounded like there. Assuming you bought the
Eighth
right
wonder of the
quality
world.
company at the right price.
That's high quality right there.
Thanks for
And
throwing
then-
in the variables, Dan. I like it.
And then I have one additional thought. So everything that Dan just described in his final thoughts about the concept of original intent, that's Bitcoin, folks.
There's so much
Hey, I
to
didn't say
unpack
it.
in that comment. There's so
Yeah.
much to unpack in that comment. I can't even tell you. But I'm not going to go there because we're supposed to close our comments up.
Leave that. We'll be back on that subject again sometime, people. And thank
Touche,
you.
Nathaniel. Touche.
There'll be more on that to come. Well, that's what we got for the show today. Thank you everybody for joining us today. We always appreciate your attendance. And until next time, have a great night. Take care.
Thank you for taking the time to start your journey of thinking differently and listening to LBW talk about stuff they love. Until next time.